next, a speaker who will be very familiar to those of you who have attended Think Tank over the years. Mark Baribeau is Head of Global Equity at Jennison Associates. He is the co-portfolio manager of the Global Equity Opportunity Strategy, which has been part of our funds for over a decade. Since that time, the strategy has returned 13.5% per annum. That is 4.1% ahead of the MSCI World Index, again per annum. Mark presented at Think Tank last year as we approached the bottom in equity markets. He was very honest about performance. I think you said it sucked, Mark. But nonetheless, he said conditions were increasingly in place for things to change. And since then, the strategy is up by around 22%. I think I was looking on Friday. That's ahead of the MSCI World Index, ahead of the Associated Growth Index, and ahead of the Associated Momentum Index. So take your pick. Our analysis concludes that the strong performance Jennison have delivered over the short as well as the longer term is down to skill and not luck. But I will let you make your minds up on that by promptly handing over to Mark. Ladies and gentlemen, Mark Baribeau. Thank you.
Thanks for that introduction. I'm glad I'm here this year and don't suck anymore. So I'm gonna try to go through a lot of material really quickly because there's a lot to talk about. There's a lot of interesting things going on in the global marketplace that are quite exciting. So I'm gonna hit first on sort of current market dynamics, just what's happening in growth stocks generally, put it in perspective of the longer term, both in terms of valuation and scarcity, and then talk about where the opportunities we think are today that are providing the good returns so far you're seeing this year, and in fact in the trailing 1 year, and looking forward into 2024 and beyond, because there's big structural shifts going on right now that are quite interesting. So let's go fast forward. Well, first, there's a lot of little bullets on here, hard to read, but essentially 2021 into 2022, you just had a big drop in valuations because interest rates rose very rapidly. But for growth stocks, there was an added pressure. There was a real concern in the marketplace about demand pull forward for goods and services that, the big tech leaders, e-commerce leaders, media companies, certain healthcare companies were delivering during the pandemic, where their secular growth was very robust, but then it accelerated. And is there going to be a lot of demand pull forward and give back in 2022, 2023? And there was in some cases, there wasn't others, it was not. But that uncertainty really weighed on valuations. By June of last year, you kind of cleared the decks on a lot of the, at least expectations. So there were still concerns ongoing in the marketplace, but valuations had reset, and that was very important. So the opportunity set we see now going forward is in 5 principal areas, but I'm going to only talk about a few today. Number one is the generative AI boom. That's going to be the 4th era of computing. It's really significant, and we think it's important to have the portfolios focused there. Secondly is what's going on in consumer brands and consumer models in general. The direct-to-consumer model is far superior. That is, you can only buy products from a brand through their retail distribution or their e-commerce site. They control everything, the engagement, the pricing, the inventory. They're winning big in the marketplace globally. Others are faltering. Third, the big transformation in mobility. This is going to continue. Obviously, it's the move to electrification and autonomous driving. Both are a collision course for the traditional auto industry, which is not going to be able to handle it well. Most of the profits coming out of that transition are going to go to technology platforms. And then lastly, we'll talk a little bit about the reindustrialization of some developed economies, particularly the United States, as everybody tries to move aggressively out of China and reliance on that supply chain. So, a lot to talk about. First, just why do we focus on growth? Those blue bars, this is since 1997, rolling 5-year returns. That top quintile of growth in the market generates very high double-digit returns, high teens. The second quintile, also very powerful. Those are more of those durable, low double-digit growers. Great place to invest as well. Almost harder to find than the special ones because it doesn't last as long. Last year, in 2022, you can see in the green bar, all flipped on its head. Very unusual. The faster you grew, the worse you did as a stock. The slower you were growing and not growing at all, the better you did. That just reflected the valuation shift. It's right sizing this year. So far through the first half of the year, that top quintile is driving the market globally. And of course, we all know about the concentration of the market. It's now called the Magnificent Seven, which I don't know who termed that, but it's better than FANG. We're happy to see it. Why is it so powerful this year? Valuations. If you look at the left side of the page, this is growth relative to value. The relative PE almost dropped to parity for very powerful growth franchises. The lowest since 2008 in the financial crisis. Even with the big rebound so far this year, it's barely moved off the bottom. You haven't missed a thing if you're not invested in this part of the market. It's just beginning. Growth is very concentrated over time. If you go back to 2005, we look at rolling 3-year revenue growth and earnings growth production. That little green sleeve, that's companies that are able to grow their revenue 7 to 12%, 7 to 15% a year, earnings per share growth 10 to 20, a very small part of the market. The faster growers, that light green or whatever color that is, grass green, I guess, is even smaller, only 11% of the market. That's companies that can grow revenues faster than 15% a year. So only a quarter of the global stock market has the power to grow top line. It's really small. Why does that matter? Because most equity returns over time are concentrated. They're not distributed in the market. This is a famous study that came out a couple years ago. If you look at the US stock market, 1926 through 2019, that's a long time, 4.8% of stocks over that entire time period account for the entire wealth creation of the stock market. 4.8, that's it. If you look at MSCI All Country World, it was launched in 1990. You do the attribution there. 1.8% of the stocks in the global stock market index account for the entire gain of MSCI All Country World since 1990. 1.8%. Returns are not equally distributed. You have to be in the big leaders that are making huge difference in the world, scaling their operations, and generating tons of cash flow. Those are the big winners. That's why they keep dominating today. I'm going to jump ahead to style quickly. The other reason growth is bouncing back this year, the global economy is slowing. When earnings growth slows, and it's less than mid to high single digit, the blue bar on here, growth stocks dramatically outperform. If earnings go negative in the market, like a recession, it's even a bigger spread. So one of the reasons we're pretty confident about the setup this year is we entered 2023, we had valuation on our side, and we had earnings growth on our side. And so far it's played out, and I don't think that's going to change in the next year. Where are we focused? Okay. The only technology that matters going forward is AI. This is the next big mega trend that we're all looking for. Where is it going to come from? The mobile internet was the last big one. It lasted more than a decade. It powered all these great stocks, Apple, Google, et cetera, Facebook, because of the fact that you could transform all that information and carry it with you and compute in your pocket was a big deal. and it created applications we never dreamed of years ago. So the new one now is generative AI, these large language models that are going to enable us to do more creative things with fewer resources, more productivity, better applications coming from software companies. Think of it as a personal assistant for you and I to do all sorts of planning, execution, buying on day-to-day living. ChatGPT was launched on November 29th last year. It's the fastest app to ever get to 100 million users in history. And you can see, I mean, it's a straight line up. And that's why there's so much interest in this area. It took the world by storm. All technology companies that we follow are pivoting all of their future product planning to embed this either in their workflow for their own productivity purposes or for applications for their customers. So it's here and now. It's not hype, and we'll see in a minute how you think you play it. You can't really invest in the application layer yet. It doesn't really exist. You can play around with ChatGPT, but you can invest in the infrastructure layer. This requires enormous compute power. And it starts with silicon. So you have obviously NVIDIA. That's the powerhouse of the global stock market this year. It is the must-own stock for this generation. But there's others. If you think about a Tesla, they train their autopilot on NVIDIA GPUs. They're also trying to build their own supercomputer that can handle that load. And then once the algorithms are trained, they download that software onto your car. The car has its own application-specific chip, the brain, that runs all those cameras, gets all the information, and drives the car in real time with no latency. So the application-specific chip at the edge of AI is going to be very, very important, and they're very powerful. And so a company like Broadcom, which is a leader in the manufacturing of these or design of these, is key. Down the food chain, the sophisticated nature of semiconductor design today, because Moore's law is dead, you can't keep just shrinking the chip. It just has to get more and more sophisticated, like city on a chip. You need the architecture. That's Cadence Design Systems. As it goes AI, it gets more powerful. And you have a massive supply chain shift out of Taiwan, effectively out of China, although China is also building its own semiconductor capability in the United States, Europe, and Japan. So you have a building boom going on. That benefits ASML and Applied Materials. On the cloud computing side, the middle part, all the workload so far for AI is going to occur on these big data centers. Microsoft Azure is in the lead because ChatGPT, OpenAI, is on that platform. So if you're using ChatGPT, it's going right to Microsoft's Azure data center. So far, Google's not a big player in the new generative AI market. They're obviously the largest AI company in the world. But the generative AI market, they're not a big player yet, although they're working on it. And Amazon AWS is really getting no revenue from this yet. But given what we know about capacity, it's inevitably going to leak its way into all of these big players. The software side, we don't know what's happening yet. We can't really tell. We do know that you have a non-traditional, non-structured data. So you have video, text. Think of Tesla. It's all video. It's camera shots. There's a lot of information coming in that's not pieces of data. It's unstructured. So you need an unstructured database to manage it that's cloud-based. That would be MongoDB. We think they're going to be a winner from this. Their business is already accelerating this year just from their base business, but we think it could be a platform company for generative AI. We just don't know yet. But the business is doing fine already. Why is NVIDIA so important, and why is this not hype? Well, this is real revenue. NVIDIA shocked the world in May. We call it the big shock day of AI. They raised their revenue guidance for the next quarter by $4 billion, from 4 to 8 for data center. That kind of revision is unprecedented in the history of my tech investing going back to the mid-90s. It just has never happened before. So their data center revenue is going to more than double this year. Even these estimates are a little old right now. So they're the lead player. You need their GPUs to run these systems. That won't be true forever, but it's true now, and it's true for the next 1 to 3 years. So meanwhile, valuation on this stock has collapsed, because that's the other question people ask. It's up 200% year to date. It's the biggest holding in our portfolio for momentum, thankfully. And its PE multiple on next year's earnings on consensus is 27 times. It's not expensive. And it's because of the huge revisions upwardly in the stock. How big could this be? Well, if you look at data centers and cloud-based computing, it took 18 years to get to 100 billion of revenue. That was through 2018. It then took only 2 years to do the next 100 billion. So we think, it's reasonable to assume that, and this is Piper Sandler estimates, but we think it's realistic. You're going to go from 2 billion to 100 billion in 8 years, maybe quicker, but it's not going to take 18. So again, big addressable market opportunity. That's a lot of money going into technology products and services. We have to be there. Semiconductors are the other big beneficiary. The blue on this chart is the fourth era of computing. The red, last one we just came out of. So generative AI will be the fourth. It could be the biggest, but it's going to be significant. It's going to take the semiconductor industry to $1 trillion in revenue by 2030. And we talked to the semiconductor companies, and they all kind of bless this number. They actually think it's likely. And that means a big CapEx boom. And here's the subsidies that are being thrown around the world. I mean, it's $66 billion in the US. It's Europe, $47 billion. China, $143 billion. So China's trying to build its own semiconductor industry as well. So lots of picks and shovels here, lots of equipment sales. You probably don't want to own a semiconductor stock when all this capacity gets built, but the equipment plays should be pretty good for the next few years. So we want to be positioned there. That's like an ASML or Applied Materials. Valuations. All right, let's compare this period right now to prior booms. If you look at the last one, the internet era, March 2000, the valuations today are nowhere near where they were back then, or the peak, which is that sort of zigzag line for the leaders. We're not anywhere close to it for the cluster of AI stocks that you can kind of put in that bucket. And even in the NVIDIA number on the far right of this chart is old. This chart's a little old. It's actually lower than that. Why? All of these big tech leaders, these AI leaders, including NVIDIA, generate a ton of free cash flow. They have very high free cash flow margins versus the internet peak in 2000, free cash flow margins were negative for the leaders. And today, they're the best in the market, in the entire global stock market. So it's a lot of valuation support here because of the free cash flow. All right, switching gears, direct-to-consumer models. This is the other big trend that's out there that's just showing up now in the last few years as driving massive differentiation in consumer brands. So what do we mean by direct-to-consumer model? If you think of Hermès, if you want to buy Hermès, you can buy it in their store or on their website. You can't buy it anywhere else. If it is sold in a department store, it's going to be a high-end one where they are controlling the shop. The department store doesn't get to touch a single thing. And the reason is this direct-to-consumer model enables them to control their engagement with their customer, the experience, all the remarketing campaigns, and most importantly, inventory. So they don't get involved with excess inventory in a part of the world or a part of the channel they weren't anticipating. They can control it all, they can move it quickly, and their supply chains tend to be vertically integrated because they have these models. It's not just luxury goods, it's also companies like Lululemon, same kind of direct-to-consumer model. These brands, if you match them up, compared to the broad market, here it's luxury goods versus Europe, return on invested capital, dramatically higher and expanding. If you were to compare these direct-to-consumer models in general to non-direct-to-consumer models, same trend. They're winning big in the marketplace globally because of that control, and you just have to have it today. The other thing is in mobility, I think I've showed you this chart before, but EV penetration rates, as you know, are rising rapidly. China's sort of past the inflection point. It's above 20%. It's now really going to accelerate. Europe is almost there in general. There's puts and takes. And the United States is still just below 10%, but that's moving quickly. And you can see the numbers here. That dotted line is the year-over-year growth. It's around 50% in July. So this is with all the economic concerns, and and China is the weakest market with units up 32% in July, although they're up 43% year to date. But Europe, units up 50% year over year. The United States, units up 50% year over year. Those are the three big markets in the world for autos. Combustion engine sales are mostly negative year over year. So this is a big, big difference. By the way, you can see in the bars, China in the blue accounts for about half of all EV production and sales in the world. When you think about an industry going through a massive disruption, there's always a driver, no pun intended. There's the disruptor, which is Tesla. Comes out of the blue, changes the game, the rules of the game, real time. And the incumbents say, no, nobody wants them. Where do you plug it in? Blah, blah, blah. And meanwhile, consumers en masse are just flocking to it. And then there's the sort of the copycat version where we can manufacture them faster, cheaper, not necessarily at the high end, but good enough, and take a huge part of the volume market and then win. That would be the playbook of Toyota 40 years ago and the Korean automakers 30 years ago. Well, guess who they are today? They're all Chinese. So watch out for China. They're about to dominate the global auto industry because of this move to electric vehicles. By the way, in the first half of this year, the Tesla Model Y became the best-selling car in the world, passing Toyota Corolla. So the baton has been passed to the next generation officially. But there's more disruption coming, particularly since the move to EV also involves the move to autonomous driving, which plays into artificial intelligence. We think there's only going to be 3 companies that play in this market going forward. It's going to be Tesla with a leader, and either NVIDIA and Mobileye as the counterweight in the industry, as all other OEMs are forced to buy their technology to compete against Tesla. So that's what we think is going to happen, including in China, by the way. The other interesting trend is this onshoring of supply chain. We read a lot about it. Some people call it deglobalization. I don't think there's any deglobalization going on. It's de-Chinification. Let's be honest, that's what it is. And it involves also issues of security. So that's why the biggest move, the biggest boom is occurring in leading edge technology. It's not occurring in traditional manufacturing. So when we look at, this is just the US, this is construction spending on manufacturing. I mean, if that were a stock, we would buy it. We wouldn't even look for a pullback. We'd be plowing in, I'm sorry. This is a really important move. And it's occurring in electric vehicles, battery, storage, and alternative energy tied to that. And it's occurring in semiconductors. That's where the big money's moving. So we're trying to get ideas into the portfolio that can participate in this sort of, again, picks and shovel boom that's going on. I'm going to skip a couple of these. I mean, just quickly, 670 billion mega projects announced in the US and Canada related to this. These are big numbers. It's going to be wild. And this one just shows, it's the blue line. It's leading edge technology where all the building is, traditional manufacturing, the orange line going nowhere. All right. Quickly on the portfolio, you heard the numbers, year to date, up over 30% and excess return of 17 plus. What's driving it? Well, earnings per share growth in the portfolio is running at more than double the market, 14.7%. These are real numbers, not estimates, and dramatically higher than the S&P 500. So it is working this year. Companies that are putting up very strong double-digit fundamental growth are winning again in the stock market, which is really important. For us, if you look at the far right of this page, the attribution, it's all coming in a few areas. Our technology portfolio is leading, 800 basis points of alpha this year, followed by our consumer portfolio at just over 700 basis points of alpha, broadly defined. Then you look at fintech, that's another 100 plus. Not owning energy is 100, and then healthcare. So all the areas we're very active are really driving performance. So again, a reversal of 2022, kind of back on track. The big winners are on the left side of this page. NVIDIA leads the way. That's 5.1% of alpha, so 5.1 percentage points. This was a big holding coming into the year. We added to it in December. We had owned it. We had cut it back early in 2022. We added back to it in December on our belief that their gaming business, just computer games, were turning the corner after digestion from post-COVID, and that the data center business would reaccelerate driven by AI. We had no idea it was going to be this big. But, it is what it is. In the top 10 includes other technology companies, including Palo Alto Networks in leading edge network security. It's really important to secure all this massive data traffic. And we think they have the leading edge going into cloud-based data security. Broadcom in ASICs, and then Cadence Design Systems and ASML in sort of the building blocks of the chip boom. The rest is consumer, and it's very diverse. There's luxury, the direct-to-consumer models, Ferrari, Hermes, LVMH. Mercado Libre, the e-commerce and fintech giant in Latin America, the Amazon of Latin America. Never missed a beat last year fundamentally. The stock went down 45% on positive revisions. And so this year it's played a huge game of catch-up as a stock because the business was never shaken. And then Tesla. So that's where the performance is coming from. This is our top 10 at the end of June. I'd be happy to take any questions.